Hello everyone. Today our group will show the presentation about the discussion of the current disclosure and reporting requirements of subsidiary by US listed company. I am Chu Jun, a member of Group 1. The author pointed out in the article that goodwill impairment is usually recognized long after the deterioration of the underlying business, and this delay brings many risks to investors and analysts. Firstly, for the information asymmetry. When goodwill impairment is not disclosed in time, investors and analysts cannot obtain accurate financial state information. This information asymmetry may lead investors to make wrong investment decisions, and they believe the company is still in a healthy state, which affects stock price and market confidence. Secondly, misleading financial statement. Delayed impairment of goodwill makes the company's financial statement more positive for the period. This mislead may lead analysts to make incorrect evaluations of the company's profitability, which influence investors' decisions. Finally, the role of auditors is limited. However, in practice, the auditor rarely has a political power or sometimes the economic incentives to get the CEO to take a write down. Auditors find it difficult to force enterprise to impair goodwill in a timely manner, which further exacerbates the risk faced by investors.
What incentives might management have to delay goodwill impairments? When a goodwill impairment is recorded, it appears as an expense on the income statement. Naturally, this will reduce the company's net income, leading to undesirable consequences for managers and arising incentives to delay impairments. Firstly, lower earnings negatively impact performance metrics such as EPS, ROA, and ROV, all of which are closely monitored by investors and analysts. Adverse market reactions to declining metrics can cause unfavorable market perceptions, a decline in the company's share price, and overall market capitalization. This not only reduces shareholder value but undermines confidence in management and tarnishes their reputation. This leads into the next incentive management may have, protecting both personal and organizational reputation. Recording a goodwill impairment is essentially an admission that management has failed to meet expectations and bought a declining company. Errors like this can have significant impacts on the way investors and the public view management's ability to make valuable strategic decisions. This is particularly damaging to senior executives who are the face of the company or those responsible for the negotiation and execution of acquiring the deal. Not only do impairments serve as a public acknowledgement of failure to judge capital allocation, but also they can erode trust amongst investors, board members, and the broader market. This can be evidenced in Harvard's 2008 Review of Accounting Studies, where it was found in many instances that managers will exploit their discretion and delay impairments to avoid reputational consequences, which can clearly be evidenced in UPS's situation, where they delayed almost $500 million of goodwill impairments to avoid disclosing management's poor performance, as well as temporarily shielding them from reputational damage, both of which are favourable for management, thus incentivising. Finally, management may also be incentivized by financial interests such as bonuses and remuneration packages. Supporting this, an empirical study from Lee found CEOs with higher equity incentives are significantly less likely to reduce timely goodwill impairments.
Hi everyone, today I will be sharing key lessons from UPS 5 billion goodwill impairment. Let's start with the acquisition strategy. When UPS acquired Overnight in 2005, it paid a large premium, recording significant goodwill. This showed high expectations for future growth, but those expectations were inflated. The freight unit was eventually sold for around 650 million with a goodwill impairment of nearly 500 million. That's a strong signal of overvaluation. So what are the lessons? First, be cautious when setting expectations. Goodwill reflects assumed future benefits. If those benefits don't exist, value is destroyed. Second, challenge inflated forecasts. Company must be realistic about growth and cost savings. And finally, avoid acquisition driven by blind expansion. Overconfidence can lead management to overpay, chasing the growth rather than the value. Now let's turn to integration. Following the acquisition, UPS failed to fully integrate freight into its core parcel operations. The LTL segment had a different cost structure, customer base, and service model. UPS Freight continued to operate independently with its own system management and even a distinct corporate culture. What's even worse is that the workforce became unionized under the Teamsters, which limited flexibility and raised labor costs. Because of the poor integration, Freight remained isolated and underperformed, leading to its eventual sale at a loss. So the key lesson here is acquisitions only work when you have a clear, dedicated integration strategy from day one, aligning structure, system, and culture.
Moreover, the UPS Freight goodwill impairment is a cautionary tale of how poor financial reporting can be erode investors' trust and lead to penalties. The first lesson is the risk of biased valuation assumptions. UPS used the overly optimistic forecasts and ignored key costs like a loss of shared service and unionized labor. Secondly, despite the clear impairments indicators in 2019, UPS delayed actions internal reviews showed Freight's fair value was well below book value. Yet management postponed impairment, showing the need for objective, timely analysis. Finally, UPS the failure to disclose material changes, claiming no triggering events, even after selling Freights as at a loss mislead investors, and breaches IAS 36 and SEC rules. Financial reporting must be transparent, timely, and reflect the true business conditions. UPS the case highlights a crucial governance lesson. When a business unit consistently underperforms, the board and auditors must challenge management's overly optimistic assumptions, especially regarding goodwill in 2019. UPS auditors approved no impairments, but later events proved this was a mistake. This shows the risk being underrated, and good governance means conducting rigorous impairments, testing possibility using independent or third-party valuations. Ultimately, UPS faced a fine and reputational damage. The importance of transparent and fair financial reporting can be seen in this case. Even if a short-term downturn in performance creates a public doubt, it builds a long-term credibility and reflects a good governance.
Thanks to Zhicheng and Jason for the information that explains a lot. Next, we take a more in-depth look at how to use the public information disclosed by UPS to predict the potential goodwill impairment. So back in 2005, UPS acquired Overnet with a 36% premium and renamed it as UPS Freight. The main purpose was to compete with the FedEx and analog sandwiches, especially by growing its market share, customer base, and revenue. But in reality, things didn't go as planned. From 2011 to 2021, although the total revenue from UPS's supply chain solution division nearly doubled, the portion contributed by freight kept decreasing from 28% all the way down to just 6%. That clearly tells us freight didn't realize the expected synergies. Also, since UPS often discloses the freight together with other businesses, we don't have all the exact information related to this subsidiary. But even that lack of transparency suggests that management may not have confidence in freight's performance. So in 2020, UPS decided to sell freight. That decision alone says a lot. It shows the company no longer believed freight could generate the expected economic benefits. This is where the goodwill issue comes in. Remember, EPS paid a high premium for this acquisition, which means a lot of goodwill was recorded at the time. But as performance declined and expectations weren't met, the book value of that goodwill likely no longer reflected reality. So there is a clear sign for potential goodwill impairment.
So analysts could somehow utilize disclosures to focus the potential write-downs. First, the market-to-book ratio is a cross-sectional indicator that synthesizes internal accounting information with external market expectations mentioned in this article, shows how the market values compare to the accounting value of its net assets. A sustained ratio smaller than 1, especially below zero point 0.5, often reflects severe market discounting of the firm's goodwill. For example, in the article's table, Paramount's persistent low PB ratio below zero point 0.5 was later validated by
a 32% goodwill impairment in 2024. This ratio can help determine whether a goodwill write-down is warranted but has been delayed. The market-to-book ratio, well widely used, may be an unreliable impairment signal due to its sensitivity to price deviations from fundamentals if used alone, as is claimed in fair value of accounting. Hence, analysts could use other information in disclosures consistent with the example of UPS. First, segment level performance metrics such as decline in ROA and persistent losses directly indicate that the cash generating units may no longer support the recorded goodwill. Second, missed strategic targets such as EBITDA, revenue contribution, or market share goals suggest post acquisition benefits may not materialize, undermining the basis for recognized goodwill. Additionally, restructuring charges and executive turnover disclosures such as CEO changes may mirror the strategic evaluation, reflecting a reassessment of goodwill. Overall, these disclosures provide targeted signals that strengthen the assessment of potential goodwill impairment. And below is our reference list. Thank you for watching.